Well done, Yvonne. Well done, Ronaldo. And well done, Leicester. It's Yvonne, Ronaldo, and Leicester doing very well at accounting. And they've just finished certain parts of their course. And yeah, they're showing up their certificates. Well done. Right, let's move on. I'm busy with property, plant, and equipment. There we go. And specifically, I'm looking at asset disposal. So we've got property, plant, and equipment. And what we've done so far, we've done some depreciation calculations. We've captured the depreciation. We are now going to calculate the profit or loss on the disposal of a non-current asset. And we're going to capture the profit or loss of the asset disposal. We've already looked at recording expenditure on PPE, and then we might in another video just touch on the statement of financial position, the PPE note, the property, plant and equipment note. Let's just wait for that plane to go over. This is real. I'm not editing, I'm just keeping it live. Right, this is an example in a specific textbook, 10.9, but I'm using different numbers. What we have here at the end of year 2, what that means is if you watched the first video on property, plant and equipment and the second video, we have purchased and installed computer equipment to the value of 13,000 Rand. The accumulated depreciation at the end of year 2 is 6,500, and there was depreciation for year 2 of 3,250. So what we're going to be looking at in this video is we're going to actually sell this computer equipment, asset disposal. We're going to dispose of this non-current asset. But after 2 years, that's the position in the trial balance. And if we want to calculate the book value, we say 13,000. Let's make it a little bit neater. 13,000 minus 6,500. So it's the historical cost price less the accumulated depreciation to date. And to date is the 31st of December 2026, end of our second financial year, where we have this computer equipment. So the cost price less the accumulated depreciation, 13,000 minus 6,500. What is the book value of the computer equipment at the end of year 2? 6,500. Another name or terminology used for book value is the carrying value. So we're going to look in this video the net effect of asset disposal. Basically what I'm saying there is we're going to calculate whether we made a profit or loss on the sale of the asset. So let's move on. Right, so asset disposal continued. Here I've got the general ledger accounts. Behind here I have computer equipment, and I have accumulated depreciation. At the end of year 2, these are the general ledger accounts. The balance brought down for computer equipment is 13,000, and the accumulated depreciation is 6,500. So that's what's in the general ledger in these two general ledger accounts. And I did discuss that. Once again, 13,000 minus 6,500 gives us the book value or carrying value in our books. Now this is where it gets interesting. At the end of year 3, on the 31st of December 2027, Calibre Education sold its computer equipment purchased 3 years ago on the 1st of January 2025. What did they sell it for? 4,000 Rand. Complete the asset disposal account to reflect the sale of an asset. Now, I've been encouraging you to draw timelines. This is when the equipment was purchased. 1st of January 2025, year 1 took place. Depreciation was done at the end of year 1. Year 2 came to an end. Depreciation was done at the end of year 2, 2026, 31st of December. And now we're in year 3. In fact, we're at the end of year 3. And this year arrow is pointing to where we are. We've had this asset for 3 years, and now we're selling it. Sale of computer, and we're selling it for 4,000 Rand. And what was the cost price? I've looked at the general ledger accounts. The cost price of this computer, including the installation cost, if you look at previous videos, was 13,000 Rand. And now we're at the 31st of December, at the end of the 3rd year. We need to depreciate again, and this computer equipment, if you remember, was 25% per annum on the straight line method or basis. So it's 25% on cost price. The cost price was 13,000. So what is the accumulated depreciation, or the depreciation for year 3? 13,000 times by 25%. 12 over 12 is just 1. I put 12 over 12 there because it's a full year, 12 months out of 12 months. But you could have just written 13,000 times by 25% equals 3250. Now this is important. I like to just use a rough formula. That means not record things exactly how it should be done in the books before I do record it in the books. But the rough formula to calculate profit or loss on the sale of an asset is as follows: cost price less accumulated depreciation for the life of the asset that we're getting rid of, right until the date of sale. Right, that's the accumulated depreciation. Cost price minus less accumulated depreciation gives us the book value. Now in our books, this computer equipment is worth 3,250. We sell it for 4,000. Now I can see 4,000 is greater than the value in our books. Therefore we've made a profit of 750 on the sale of this asset, and that profit there is the net effect of this asset disposal, and its income, it's an increase in income, will be credited. Now we need to show all this rough work here in our books, and how we do that is we follow some steps in order to get all the information into the asset disposal account, which we're going to open to show the disposal of the asset. Step 1. Now if you're going to various textbooks, step 1 might be to depreciate up until date of sale, but I've changed it a bit. Step 1, I'm saying transfer the cost price of the asset getting sold. We selling computer equipment to an account called asset disposal. Step 2, depreciate up until the date of sale. I'm going to work through all the steps with you in a moment. Step 3, transfer the balance of the accumulated depreciation in this case on the computer equipment, to asset disposal. Step 4, record the sale of the asset. And step 5, close off this account that you've opened, asset disposal, to either a profit or loss on the sale of the asset. So step 1, we're at the end of year 3. I've said we're selling computer equipment. The historical cost price is 13,000. Step 1, transfer the cost price. So that means take this cost price, which has a debit balance, to the asset disposal account. In order to do that, I must credit this account with 13,000. But every single transaction must go through a journal. So take out the cost price of the item being sold and transfer it to the asset disposal account. And that is going to go through the general journal. And we look at the general journal. Now if I did go back here, computer equipment, to close it off, I had to credit computer equipment with 13,000, and I debited asset disposal with 13,000. And the story, the narration, transfer of cost of the item being sold to asset disposal. Asset disposal, I'll just put in there, doesn't have a category. What I mean by that, it's not an asset, expense, liability, owner's equity. It's there to show the disposal of the asset. But the net effect of asset disposal is either going to be a profit or a loss, and that has a category, either income or expense. What has happened to our computer equipment? We got rid of it, so the value of the computer equipment has decreased. That's why we credited, and it's no longer in the computer equipment general ledger account. And we're going to post that to the general ledger, and there we go. In yellow, I went and credited computer equipment because we got rid of that computer equipment, and we debited the asset disposal account with the historical cost price of the asset that we are getting rid of. So all the information we need with regard to asset disposal from that rough working I showed you needs to get into this asset disposal account. Step 2, depreciate up until the date of sale. This computer was sold on the 31st of December 2027, end of year 3. It says depreciate up until the date of sale. So we need to depreciate for the year. Debit depreciation, credit accumulated depreciation on computer equipment. And there's the calculation. 13,000 times by 25%. So same as year 1 and year 2, because it's on the straight line method. Depreciate up until date of sale. From the journal, okay, depreciation is an expense, increase in expense. The rule says debit. Accumulated depreciation, decrease in asset value, credit. Take this information to the general ledger, and there we go. Accumulated depreciation went up by 3,250 because it's year 3. That 6,500 was year 1 and year 2. Now year 3, another 3,250, and we debit depreciation with 3,250. What's that column for? Details. This is the details column for the contra account, or the cross-referencing account, the other account affected by the transaction. By the way, depreciation will be closed off to profit and loss, but we're going to do that when we do closing transfers. So all you needed to do was depreciate up until date of sale, debit depreciation and credit the accumulated depreciation on equipment, computer equipment. Right, step 3, transfer all the accumulated depreciation up until the date of sale of the computer equipment to the asset disposal account. That's step 3. So here's our accumulated depreciation on computer equipment, and the balance brought down is 975 after you balance this account. Now, in order to close this account, what are we going to do? We're going to debit this account, and it's going to be closed off to asset disposal, because that's what step 3 says. And that transaction needs to go through the general journal. So the transfer, step 3, transfer the accumulated depreciation of the computer equipment to the asset disposal account. Asset disposal gets credited, and accumulated depreciation, because it's getting closed off and it did have a credit balance, to close it off it needed to be debited with the full amount of the accumulated depreciation up until the date of sale. And now that's getting transferred to the asset disposal account. Transfer of accumulated depreciation up until date of sale goes through the general journal, post to the general ledger. So now your general ledger will look like this. This account here, accumulated depreciation on computer equipment, was debited, and asset disposal was credited with the full amount of the accumulated depreciation on the asset that we're selling, getting rid of. Now in this account here, you have the book value, because that was the historical cost price, and now you got the accumulated depreciation. The difference between the two is the carrying value or book value at date of sale. Step number 4. On the last day of the financial year, this computer equipment was sold for 4,000. Record the sale. It was sold for 4,000 cash. Must go through the general journal. Cash, the one account will be bank. Debit bank, increase in assets, and the amount was 4,000. Asset disposal gets credited, and the amount was 4,000. Now what we need to do is take this information to the general ledger, and our asset disposal account now looks as follows. Okay, there was the bank entry, debit bank, increase in assets, and we credit the sale of this asset in the asset disposal account. Now in our rough calculations, we have got the historical cost price, we got the accumulated depreciation, and we've got what we sold it for. Did we make a profit or a loss? Let's check out the quick calculation. The cost price was 13,000. The accumulated depreciation 9,750. That gave us a book value of 3,250. That amount minus that amount gives us 3,250. Then we sell it for 4,000. In our books, it was worth 3,250. We sold it for 4,000. The selling price is greater than the book value. We made a profit. And profit is, shall we say, increase in income, and an increase in income must get credited. So I close off this asset disposal by debiting the asset disposal account, because the credit side is bigger than the debit side, but I also know that we made a profit. The profit will be credited, increase in income. If the profit is credited, asset disposal must be debited. This takes a little bit of practice, The way I remember it is I do a rough calculation. If I made a profit, I know the profit on the sale of the asset must be credited because it's an increase in income. If the profit is credited, asset disposal to close off the account must be debited. If you make a loss, it's a little bit like an expense. It is an expense, a loss. The account will be debited if it's a loss. If it's a loss, asset disposal to close it off will be credited. Or you could simply say, you add up, make it a bit neater here. You do the following. You add this up. 9,750 plus 4,000 is 13,750. This side is 13,000. This side came to 13,750. Could total it there. To make the two sides equal, that means close it off to asset disposal, I need to add another 750 to the debit side. And the contra account will be profit on sale of asset. But let's move on. Rub this out. Excuse me. And there it says, it's just basically what I have said. Calculation of the amount to close off. The credit side came to 13,750 less the debit side, and the amount to close off to asset disposal is the difference between the debit and the credit side. And to make these two sides equal, I add 750 in this case to the debit side. So I debit asset disposal, and you will see I credit profit on sale of asset. That's the other account. How will we close off the asset disposal account to profit and loss? That's the last step. Close off asset disposal to profit or loss on sale of asset. And what I've just demonstrated in the general ledger, debit asset disposal, credit profit on sale of computer. And that there is credited because a profit is an increase in income. And the rule says increase in income, you must credit. Post that to the general ledger. The asset disposal account will now be closed off. And that is the net effect of this asset disposal. Profit on sale of computer equipment. Increase in income. Now what I've done just quickly to close off, these numbers are the same as what I've just been doing in the whole video, except I'm selling now this computer equipment for 3,000 Rand. So the cost price was 13,000. The depreciation for the year was 3,250. The total accumulated depreciation was 9,750. And now I'm selling it for 3,000. And what I'm trying to point out is this is now a loss. The last example, there was a profit because we sold it for 4,000, but here's a loss. What I've done here as well in this journal is I've omitted, left out the narrations, because they could say that in a test or exam, leave out the little story of each journal entry. Omit narrations. And if I do my rough working with the new scenario, same historical cost price, same accumulated depreciation, same book value, different sale amount, 3,000. In the books it was worth 3,250. Sold for 3,000. We got less than what it was worth. In brackets here, loss on sale of asset. Loss on sale of asset. Now all that information needs to be taken to the general ledger. And on the last slide here, I've now got asset disposal. There's the cost price, there's the accumulated depreciation, there's the selling amount. If I say 9,750 plus 3,000 is 12,750. Let me write that there. 12,750. The debit side is bigger than the credit side. To close this off, I must add 250 Rand on the credit side, and according to our rough calculations, we've made a loss, and a loss will get debited. This asset disposal account is closed off by crediting asset disposal and debiting loss on sale of computer equipment. And there's a 250 Rand loss. Not quite finished. A loss increase in expense, the rule says debit. So that is the end of this asset disposal explanation. In my next video, I'm going to do a full exercise on asset disposal. We'll dispose of a few different assets so you get a good idea. I look forward to chatting to you in the next video. Cheers.